Vanakkam. Welcome to part 2 of Introduction to Accounting Standards. The previous video we had covered accounting standards issued by ICAI, notified under the Companies Accounting Standard Rules 2021, and also accounting standards under the Income Tax Act or Income Computation and Disclosure Standards. In this video we are going to discuss IFRS or International Financial Reporting Standards and Ind AS or Indian Accounting Standards. Let's first look at the need for IFRS. Why do we need IFRS? So let's take the example of an investor, Mr. John, from the United States who wants to make an investment in a company in India, say Infosys. Now he wants to compare the performance and the financial health of Infosys with a similar company in the United States. Now the company in United States may be preparing its financial statements as per US GAAP, and Infosys is preparing its financial statements as per the accounting standards notified under the Companies Act. So the two don't meet. So it's very difficult to compare when there are substantial differences in the accounting treatment. But if there were a common set of accounting standards applicable throughout the world and all companies are following them, then it becomes very easy for Mr. John to compare. For Infosys, what is the advantage? It gains market access, right? So the barrier of multiple accounting standards are removed, thereby making it easier for investors like Mr. John to invest in companies in India. The same is true for Indian investors wanting to invest in companies outside India. So it's a win-win situation both for companies, their domicile countries, as well as the investors. It improves market access, it removes the barriers of multiple accounting standards, making it easier for the investors also. So who issues these international financial reporting standards? So there is a not-for-profit organization called IFRS Foundation with its head office in London, UK. It controls the International Accounting Standards Board. Just like we saw in the previous video, we have ICAI, which controls the Accounting Standards Board. So just like that, we have IFRS Foundation, it controls IASB. IASB or International Accounting Standards Board issues and periodically amends the International Financial Reporting Standards. Now it is said that IFRS is principles based, whereas the accounting standards notified under the Companies Act are rules based. So when we say principles, we mean that the general principle is set out by the standard. Freedom is given to the auditors and to the management of the companies to apply judgment and comply with the accounting standard accordingly. So in the case of rules based, strict rules are set out. To give you an example, say IFRS says that use fair value, right? Use fair value to value the property, plant and equipment. Now how to calculate this fair value may not be strictly specified. You will be given freedom to follow whichever method you think is best. But if it is rules based, that standard will tell you this is how you have to calculate fair value. This is the only way to do it. So for example, there may be a provision that use the value given by a third party valuer only, don't use any other model, right? That would be an example of rules based. But if the standard basically sets out that use fair value to value the asset, and then just leaves it at that, gives some general guidance. These are the various methods available. Doesn't necessarily specify in which situation you should use which method and so on. Then that would be an example of principles based, right? So basically, in simple words, we can say that principles based is like an inclusive definition and rules based is like an exclusive definition. Okay. So IFRS is principles based, notified AS is rules based. So let's now look at a brief history of IFRS. So till 31/3/2001, the board that was issuing international standards was called International Accounting Standards Committee, and there was another committee which used to issue interpretations for these standards, that was called Standards Interpretation Committee. After 1/4/2001, when IASC, that is International Accounting Standards Committee, was reorganized, it became IASB. So just like we have ASB in India, we have IASB that issues international standards. And interpretations that were issued after 1/4/2001 were issued by International Financial Reporting Interpretations Committee, or IFRIC. So IASC became IASB, SIC became IFRIC. So what does IASC issue? It issues accounting standards in the international context. Same way IASB. SIC used to issue interpretations, IFRIC now issues interpretations. So there is a specific term for the accounting standards issued by IASC. They used to be called IAS, or International Accounting Standards. The standards issued by IASB are called IFRS, International Financial Reporting Standards. SIC used to issue interpretations for IAS. IFRIC issues interpretations for IFRS. Now comes an interesting twist in the terminology. When we say IFRS, it not only includes the accounting standards that are now being issued by IASB, it also includes the accounting standards that were previously issued by IASC. So in other words, it has a general meaning and a specific meaning. So the general meaning of the word or the abbreviation IFRS is, it includes IAS issued by IASC, interpretations by Standards Interpretation Committee, the accounting standards that are now issued, also called IFRS, issued by IASB, and then interpretations by IFRIC. So IFRS in its general meaning includes 4 terms. IFRS includes IAS, interpretations for IAS, IFRS, that means the specific standards that are now issued by IASB, and interpretations by IFRIC. So let's now look at the 2 roads available to countries to follow IFRS. The first road or option is called adoption. The second is called convergence. So in adoption, basically what that country will do is, it will delete its own accounting standards and it will just follow IFRS 100%, no changes. But if the country feels that there are some provisions in IFRS which cannot be applied in the Indian context, then what that country will do is, it has notified AS, it has IFRS, it will prepare another set of accounting standards which are known as converged accounting standards. So, what do we mean by converged accounting standards? The notified AS and IFRS converge to give this new set of standards, and this is what we refer to as Ind AS. Please remember that AS notified under the Companies Act, they are also Indian accounting standards only. But when we say Ind AS, we refer to the third set of standards, which are converged accounting standards. So, basically the notified AS and the International Financial Reporting Standards, an attempt is made to converge them both, so that we comply with IFRS. At the same time, situations where it is not practical to implement certain provisions, we don't follow those provisions that are there in IFRS. We revert to our local accounting standards. So, these are the two options available. Countries can follow either the path of adoption or the path of convergence. So, which option has India followed? India has followed the path of convergence, and that is what we are going to study, right, in AS. So, now you may be very happy. So, we had notified AS, we have IFRS. Now, our job is simpler. We need to study only Ind AS. That is not the case. Notified AS is still there. Okay, not all companies need to follow Ind AS. Okay, only companies fulfilling certain conditions will follow Ind AS. For other companies, notified AS, that is AS notified under Companies Accounting Standard Rules 2021, that continues to apply, right? So, you have notified AS, you have IFRS, you have Ind AS. Okay. So, let us now look at how Ind AS are framed. So, this process is similar to framing an accounting standard. Only thing is, the starting point is that IASB issues the new IFRS or updates an existing IFRS. So, in the first step there is a change. After this, the procedure is more or less the same. So, what did we see in the previous chart? This is what we saw in the previous video. First, ASB identifies areas, constitutes study groups, then preliminary draft, exposure draft, final draft, and the council issues in the case of non-corporates or sends to NFRA for corporates. MCA issues the accounting standard. So, from here on, the process is more or less the same. So, once IASB issues the new IFRS or updates the existing IFRS, so this next step is by ASB. So, deliberation of the draft in days in line with the new or updated IFRS. Preliminary draft is prepared, and then exposure draft circulated in the public domain, and after comments are received from the exposure draft, the final draft is prepared. Now, the council does not issue it, it is sent directly to NFRA, and MCA in consultation with NFRA issues the Ind AS. So, one good thing about Ind AS is it applies only to corporates, it does not apply to non-corporates. So, that is why you do not see the permutation there, either sends ICI issues in the case of corporates or sends to NFRA. So, there is just one possibility. So, the starting point is different. IASB issues the new IFRS, and from then on it is more or less the same. ASB takes over, prepares preliminary draft, exposure draft, final draft, sent to NFRA, and NFRA advises the government, which issues it through MCA, right. Next, let us look at who should follow Ind AS. So, the entities covered are companies, non-corporates are not covered. So, the main notification is Companies Indian Accounting Standard Rules 2015. Just like for accounting standards, the rule was Companies Accounting Standard Rules 2006. later replaced by the Companies Accounting Standard Rules 2021. For Indian accounting standards, the notification issued on 16/2/2015 was called Companies Indian Accounting Standard Rules 2015. So, all companies falling under these criteria will have to follow Ind AS. So, non-banking finance companies, being companies, are also governed by this. Banks, which are companies, governed by this notification. Insurance companies, they are also companies registered under Companies Act. So, they are also covered. But since they are additionally governed by other laws, like NBFCs, banks are governed by the RBI Act, insurance companies by the IRDA regulations. So, then there are also mutual funds under SEBI regulations. So, which of these currently are required to follow Ind AS? In general, companies, apart from that, NBFCs should follow Ind AS, non-banking finance companies, and mutual fund schemes should follow Ind AS. So, this is just an overview. Companies in general, NBFCs, mutual funds. Other banks not required to follow as of now. Insurance companies also not required to follow. So, for implementation, different timelines were given, and these are called phases. So, when the notification came out, there was a voluntary phase. That is, companies had a choice. If they wanted, they could follow from the year of the notification itself. The notification was issued in 2015, 16th February 2015. If they wanted, from 1/4/2015 itself, for the accounting periods commencing on or after 1/4/2015, if they want, they could prepare as per Ind AS. So, a choice was given in general, okay, but this choice was not made available for non-banking finance companies, okay. So, companies in general could follow earlier if they wanted, no such choice for NBFCs. And then there was a mandatory phase. So, first mandatory phase was for companies in general, excluding NBFCs, and under that there were two sub phases depending on the criteria. Basically, bigger companies had to follow it earlier. So, there were two sub phases in this mandatory phase. One was 1/4/16, 1/4/17, other was 1/4/70. For NBFCs, 2 extra years time was given. For NBFCs, it was 1/4/18 and 1/4/19, and for mutual fund schemes, the phase began from 1/4/2023. Okay. So, voluntary phase for companies other than NBFCs, if they wanted, they could follow from 1/4/2015, that is accounting periods commencing on or after 1/4/2015. Mandatory phase for companies based on their size, for some it was 1/4/16, others it was 1/4/17. For NBFCs, it was 1/4/18 and 1/4/19. Bigger NBFCs had to follow from 1/4/18, slightly smaller had to follow from 1/4/19, and for mutual fund schemes, the date was 1/4/2023. So, the current status of the applicability for companies, here there is an additional exception. What is that exception? We will see. So, companies, we will just say yes, they have to follow as per the phase criteria, that is voluntary phase is available, and then you have mandatory phase 1/4/16 or 70. So, even companies fulfilling those criteria, if they were listed on a small and medium enterprise platform, SME platform of a stock exchange, or an institutional trading platform, they need not follow. So, stock exchanges have dedicated platforms for certain kind of companies. So what are SME platforms and which kind of companies can be listed on SME platforms, institutional trading platforms, we are going to see shortly. Just one note for you that the text of the notification, that is Companies Indian Accounting Standard Rules 2015 with subsequent amendments, still contains the phrase institutional trading platform, but this is actually now Innovators Growth Platform. Okay, so institutional trading platform is the old name which still continues in the text of the Ind AS notification, but it is actually the Innovators Growth Platform. Okay, so just remember, companies have to follow, they have voluntary phase, mandatory phase, two sub-phases, one for 16, one for 17, and what are those criteria and all we will see. There also they have exceptions. If they are listed on an SME or institutional trading platform, it's not mandatory for them. NBFCs, they have to follow Ind AS as per the phase criteria 1418 and 1419. So for banks, as we discussed earlier, banks and NBFCs, they are also additionally governed by RBI Act. Insurance companies are governed by IRDA regulations. Scheduled commercial banks are supposed to follow Ind AS, but as per the RBI directive, the implementation has been deferred till further notice. So as of now, today, banks need not follow. Urban cooperative banks and regional rural banks need not follow Ind AS at all. Insurers, that is insurance companies, being companies, they are covered under Companies Indian Accounting Standard Rules, but IRDA regulations have directed that the implementation be deferred till further notice. So as of now, it is not applicable to them. Insurance companies need not follow. Mutual funds are not exactly arranged as companies, but because they are governed by SEBI guidelines have mandated that mutual funds also should follow Ind AS. Okay, so we will see mutual funds in a little detail. Who exactly has to follow Ind AS in the case of mutual funds? We have asset management company, sponsor, trustee, and so on. So all that we will see a little later. So as of today, who should follow? Companies except those listed on SME or institutional trading platform. NBFCs should follow. Scheduled commercial banks, insurance companies, it's applicable, but implementation has been deferred. Urban cooperative and regional rural banks will not follow. Mutual funds have to follow as per the SEBI mutual fund regulations. So let's now briefly discuss what kind of companies can be listed on the SME platform and what kind of companies are allowed to be listed on the Innovators Growth Platform. You still see the words institutional trading platform here because in the Ind AS notification no corresponding amendment has been made as of today, and in the study material also, CA final FR study material, as of today you still see the words institutional trading platform, but it's actually Innovators Growth Platform. So what we are going to discuss now is only for reference. Okay, it's not really important for the exam, but it's good to know so that we don't just study something blindly. Okay, so what kind of companies can be listed on the SME platform of the Bombay Stock Exchange? The overall intention behind these criteria is that companies which require support, at the same time they should be genuine companies. Okay, they are allowed to be listed on the SME platform. So what are they? First condition, post issue paid up capital should not be more than 25 crores. Net worth should be at least rupees 1 crore. for 2 preceding full financial years. Tangible asset should be 3 crores or more in the last preceding financial year. Operating profit of rupees 1 crore should have a minimum 3-year track record, and if there is no track record, then it should be appraised and funded by financial institutions. Leverage ratio not more than 3:1. That means debt should not be more than 3 times equity. Securities should be dematerialized. Company should have a website, and there should be no change in the promoters in the preceding 1 year from the date of filing application. So what do we understand from these criteria? Basically, these are companies which require some kind of support. We don't want to burden them with the entire set of regulations to be listed on the stock exchange. So this is like a fast track application for them. Okay, as long as their post issue paid up capital is not more than 25 crores and they have some minimum criteria. Minimum criteria is to make sure that they are genuine companies. Otherwise, all these dummy companies will get listed on SME platform, and it will become easy for pump and dump schemes, as they call it. Just raise the stock market prices and then sell, offload all your shares, make a quick profit and get away. We don't want that. So we want to set at least some minimum criteria. So that is why we have these criteria. Similar criteria are there for the SME platform of National Stock Exchange also. So post issue capital not more than 25 crores, and then a track record of at least 3 years, then operating profit minimum rupees 1 crore, and so on. So next, briefly let's discuss what kind of companies can be listed on the Innovators Growth Platform. So in the Ind AS notification, still the words institutional trading platform are used. So this is para 283 of the SEBI issue of capital and disclosure requirements regulations, last amended March 8, 2025. So there is a note here, note number 481, which we will see. So para 283 basically says issuer which is technology intensive in the use of technology, information technology, intellectual property, data analytics, biotechnology or nanotechnology. So they shall be eligible for listing on the Innovators Growth Platform. Some additional conditions are also there. Okay, who should be holding the capital? 25% of the pre-issue capital should be held by qualified institutional buyers, Innovators Growth Platform investors, and who are they? There is a note for that, note 485, and some specified entities. So Innovators Growth Platform investors are basically individuals with gross total income 50 lakh rupees annually. Okay, or minimum liquid net worth of 5 crore rupees. Similar conditions, body corporate net worth of 25 crore rupees, family trust net worth of 25 crore rupees, and so on. And they also need to follow an accreditation process before they can be classified as Innovators Growth Platform investor. So these are conditions to be Innovators Growth Platform investors. So basically, who can be on the Innovators Growth Platform? Technology intensive companies with 25% of pre-issue capital held by certain kinds of investors. And for Innovators Growth Platform investors, there is some minimum criterion, income and net worth criterion. Same way for companies and trusts. They need to follow an accreditation process, right? So this note number 481, just so that you are completely convinced. So this is note number 481. So this is basically a substitution. Para 483 was previously like this: following issuers shall be eligible for listing on the institutional trading platform. intensive in the use of technology, information technology, intellectual property, data analytics and so on. And then pre-issue capital held by certain investors. Before it was 50%, now it is 25%. So all these kind of companies can be listed on the institutional trade innovators growth platform, previously called institutional trading platform. So why are we seeing all this? So practically when you audit some companies, you need to check whether they are listed on SME platform or innovators growth platform, and you may have to work with companies who want to get listed also. So this is just for reference to keep things practical. So now what we are going to do is we are going to discuss the phases in detail. Okay, what kind of companies? 1/4/2006 is the applicable phase. For which companies it is 1/4/17 and so on. Okay, but before we study the phase criteria in detail, we need to understand the concept of net worth, because all these criteria are based on net worth. So how is net worth calculated? Let us discuss that now. Section 257 of the Companies Act. So net worth is basically paid up share capital and free reserves. Securities premium account should be included, and then any debit balances in P&L, accumulated losses, deferred expenditure, miscellaneous expenditure not written off, they should be subtracted. Revaluation reserves, write back of depreciation and amalgamation also to be excluded. So in a table form, net worth can be represented like this. You can pause the video here and go through this table. So now we come to the actual phases. Broadly we know voluntary phase and mandatory phase. So when was the notification issued? 16/2/2015. Companies Indian Accounting Standard Rules 2015 notified. All these dates that you see, they are not due dates. They are the starting date of the accounting period. So when you see 1/4/2015 here, it is the starting date of the accounting period. So if you are following April to March, then 1st April 2015 to 31st March 2016. If you are following calendar year, 1st January 2015 to 31/12/2015 will not get covered here. Okay, but 1st January 2016 to 31/12/2016, that will get covered here. So these dates are for the financial statements for accounting periods commencing on or after 1/4/2015. Same way for the other dates. So which companies had the option? In general, any company could follow Ind AS for its first accounting period on or after 1/4/15, except banks, NBFCs, insurance companies. They were not given the option to follow Ind AS earlier than when it was mandated. All other companies, if they wanted, they could have followed for their first accounting period commencing on or after 1/4/2015. First means not from when the company was formed, it means in reference to this date. Okay, so if you are following calendar year, what is the first calendar year after 1/4/15? That is 1/1/16 to 31/12/16. Okay, so that was the voluntary phase. Then next is 1/4/16, that is accounting period should start on or after 1/4/16. Who had to follow Ind AS? Basically listed companies with net worth of 500 crores or more. Okay, so that listed company, if it was listed on an SME platform or innovators growth platform, which we saw earlier, then it will not get covered here. So, companies other than SME or innovators growth platform companies. Okay. So, that stock exchange can be in or outside India, and it may not be listed, it may be in the process of listing both equity and debt securities. Okay. So, such companies had to follow Ind AS for the first accounting period on or after 1/4/16. Unlisted companies with minimum net worth 500 crores or more, holding subsidiary, joint venture or associate of A or B. So, that means if there is a company H Limited, H Limited is a holding company, parent company, it has a net worth of 600 crores, it has a subsidiary S Limited, S Limited has a net worth of 200 crores, not listed. Should S Limited follow Ind AS for its accounting year 1/4/16 to 31/3/17? Answer is yes. So, any one in that relationship, holding subsidiary, joint venture, associate, if it is covered in this date, the other entity in the relationship will also have to prepare Ind AS for the same date. Next phase is 1/4/17. So, accounting period commencing on or after 1/4/17, same similar definition. Listed company but with net worth less than 500 crores, unlisted company with net worth 250 crores or more but less than 500, holding subsidiary, joint venture or associate. So, only for unlisted companies there is a minimum net worth, for listed there is no minimum net worth. That means going forward all listed companies, so once a company gets listed it has to follow Ind AS. Unlisted companies, when they reach 250 crore net worth, from then on they have to follow Ind AS. Okay. What about other unlisted companies? Do they need to not follow any AS at all? No, they will have to follow the 27 notified AS under Companies Accounting Standard Rules 2021. Okay. So, the next date is 1/4/2018, that is accounting periods commencing on or after 1/4/2018. This point is specifically for NBFCs, both listed and unlisted, with net worth of 500 crores or more, holding subsidiary, joint venture or associate NBFCs of the above. Please note that both should be NBFCs, that is the company in point A which is having a net worth of 500 crores or more and the company in point B, both should be NBFCs. Only then this date applies. So, for example, there is H Limited, a holding company which is an NBFC, it has a net worth of 600 crores. So, for which accounting period will it prepare Ind AS financial statements? 1/4/2018 to 31/3/19, assuming it is following financial year. So, this H Limited has a subsidiary S Limited which is also an NBFC, but this subsidiary does not have net worth of 500 crores or more, its net worth is say 200 crores. So, from which date will the subsidiary S Limited, which is also an NBFC, follow Ind AS for the accounting period 1/4/18 to 31/3/19, right? So, when we are talking of NBFCs, the phases for NBFCs, both the companies in the relationship should be NBFCs, then only this date applies. Okay, please keep that in mind. So, the next date is 1/4/2019. This is also for NBFCs which are listed with net worth less than 500 crores. That means all listed NBFCs with less than 500 crores should follow Ind AS for the accounting year 1/4/19 to 31/3/20 and later. If they are unlisted, as in the case of companies, they should have a minimum net worth of 250 crores, that is 250 crores or more, but less than 500 crores. And then holding subsidiary, joint venture or associate NBFCs. The same point that applies to companies, that is those NBFCs are listed on SME or Innovators Growth Platform, even if they are listed, they will not get covered here in this category. So basically NBFCs have 2 years extra compared to regular companies. For regular companies 1416 and 1417, for NBFCs it is 1418 and 1419, right? So when we say 1418, 1419, and when we are talking about the holding subsidiary, associate or joint venture relationship, by virtue of that relationship, if you want to take advantage of this later date, then both should be NBFC, right? Both the company which has net worth more than 500 crore or less than 500 crore and the holding subsidiary, associate or joint venture, both should be NBFCs, only then they can take advantage of this later date. If one is regular company and the other is NBFC and there is a holding subsidiary relationship, then how to apply the dates? That is something we will see a little later, okay? So the next date is 1/4/2023. That is for mutual fund schemes mandated by the SEBI Mutual Fund Amendment Regulations. So AMC means Asset Management Company. So the responsibility of preparing financial statements for mutual fund schemes rests with the Asset Management Company. Let's just briefly look at the different entities involved in a mutual fund so that we understand this better. So just remember 1/4/2023 or later, that is accounting periods commencing on or after 1/4/2023. Ind AS financial statements for mutual fund schemes, okay? So think of mutual fund as a ship. So you have mutual fund. There is a sponsor who designs and builds this ship. There are trustees who ensure that the ship sails safely. And then there is an asset management company which steers it towards investment goals. So a sponsor is an entity which initiates the mutual fund, establishes the trust. So for example, for HDFC mutual fund, the sponsor is HDFC Bank, okay, and then there is a HDFC trust with trustees who oversee the interests of the investors. So the trustee, actually the trustee is the legal entity which collects money from the investors and invests it on their behalf, okay. So in the books of the trustee, liability side you will have unit capital, asset side you will have all the investments made under the various mutual fund schemes. But the trustee does not manage the mutual fund, okay. Who manages the mutual fund, that is day-to-day basis, who monitors all the investments, makes rebalancing and other changes if necessary, that is the asset management company, okay. So asset management company does the day-to-day managing and operations. And then there are the individual fund schemes. So you have equity scheme, debt scheme, growth schemes and so on. So the date that we just saw now, 1/4/2023, for mutual fund schemes, Ind AS should be followed and this mandate is given to AMC. So you have individual fund schemes. The accounts of these individual mutual funds should be prepared as per Ind AS. By whom? by asset management company. So the mandate is given, the direction is given to the asset management company by SEBI. SEBI is telling the asset management company for individual fund schemes for the accounting period on or after 1/4/2023, you should make sure that it is as per Ind AS. But then what about books of the asset management company itself? That is also a company, no? So asset management company itself is a company under Companies Act. For that, this 1/4/2023 does not apply. For that, which dates apply? 1/4/16 and 1/4/17. So that is different. The SEBI mandate has nothing to do with the books of the asset management company itself. What will the asset management company have in its books? So it may have some, it may have an office, it may have some property, plant, equipment. It has staff, so it pays them salary or gives them their consulting fee. It has expenses. So that is all. So if that asset management company is listed or unlisted with net worth of minimum 250 crore, then only the asset management company will follow Ind AS for its books. The mandate given by SEBI is with respect to the mutual fund scheme. Okay. So I hope this is clear. Please note that the accounts themselves will appear in whose books? The books of the trustee. Trustee is a legal entity which shows the unit capital, it receives capital and invests. So actually the accounts of the individual mutual funds which are in the trustees books should be prepared as per Ind AS by the asset management company. Okay, so that is for the accounting period on or after 1/4/2023. Asset management company itself may have to follow Ind AS if it has a minimum net worth of 250 crores or more or is a listed company, and you follow the respective phases. Fine. So to sum up, currently who should follow Ind AS? Insofar as entities are concerned, it doesn't apply to banks and insurance companies. To other companies and NBFCs, if they are listed, then it applies. So because we are in 2025 now, all those dates are past. 1/4/16/17 for companies and 18/19 for NBFCs, those are all past dates. As of today, who all should follow? Companies and NBFCs, if they are listed, they have to follow Ind AS. Of course, there is the exception that if they are listed on the SME or Innovators Growth Platform, they need not follow Ind AS. If they are not listed and if they have a minimum net worth of 250 crores or more, that is companies and NBFCs, then they should follow Ind AS. Banks and insurance companies, not yet applicable, implementation has been deferred. Apart from entities, Ind AS also applies to mutual fund schemes. Mutual fund scheme itself is not an entity. The entity is of course the trust. But whose responsibility is it to ensure that the mutual fund schemes are reported as per Ind AS? It's the responsibility of the AMC. AMC itself may come under this table. Okay. That AMC being a company, if it is listed or unlisted with net worth of 250 crores, for its own accounts, this table will apply. But for the mutual fund schemes, there is no minimum net worth and all. If it is a mutual fund, then Ind AS has to be followed. The responsibility is with the asset management company, right? So let's now look at some key points on applicability. So we may have a question, the very first time a company has to follow Ind AS, say the company gets listed during this year, middle of the year. So from the middle of the year, should it follow Ind AS? Or it reaches net worth of 250 crores, let's say in September 2025. So for the accounting year 1/4/2025 to 31/3/2026, should it start following Ind AS? So that is not practical, isn't it? So that is why when the criteria are satisfied in a particular year, For the next year's financial statements only, Ind AS will be applied. So let us quickly look at an example. So let's say we have the years 31/3/2025, 26 and 27. So on the year ending 31/3/2025, the company gets listed or its net worth touches 250 crores. Then for the year ending 31/3/2026, it has to prepare Ind AS financial statements. When it prepares Ind AS financial statements for this year, it also needs comparatives. So, but this year's financial statements it would have prepared as per AS. So, in essence, the first time it gets covered under Ind AS, it will need two financial statements, one for the current year, one for the previous year, for the sake of the comparatives. When it goes to 31/3/2027, it will prepare financial statements as per Ind AS for the year, then it will have comparatives already prepared in the previous year. So, coming back, now there is an exception. So, the first time the notification was issued, remember Ind AS was first made applicable by way of a notification, 16th February 2015. At that time an exception was given. What is that exception? So, that exception is contained in the para 4 subpara 2 of the company's Indian accounting standard rules. So, we will read this provision and then we will see an illustration to understand this better. So, the para says the net worth shall be calculated in accordance with the standalone financial statements of the company as on 31st March 2014 for the first audited financial statements for accounting period which ends after that date. So, if it had financial year ending, then you have to see the net worth on 31st March 2014. If it was following calendar year, then what is the first audited financial statement after this date? It would be 31 December 2014. So, you take the net worth on that date and then decide whether it will fall in the first mandatory phase, that is 1416 or 1417. So, all these net worth that is mentioned, on which date we should consider this net worth? 31st March 2014. But what if the net worth on 31st March 2014 did not meet the criteria? Then the next point says, for the companies which are not in existence on 31st March 2014 or an existing company falling under any of the thresholds specified in sub-rule 1 for the first time after 31st March 2014, the net worth shall be calculated on the basis of the first financial statements ending after that date in respect of which it meets the thresholds specified in sub-rule 1. So, this sub-rule 1 is nothing but the phases 1, 4, 16, 17 and so on. So, 31st March 2014, if it did not satisfy the net worth criteria, when is the first mandatory phase? 1/4/16, right? So, 31/3/15 you have, 31/3/16 you have. 2 more years you have to check the criteria. That is what this point means. Okay. So, in other words, you have to check whether the net worth meets the criteria on 31/3/14, 15 or 16, whichever is earlier. That means if it met the criteria on 31/3/14, say net worth was 250 crores. 31/3/15 and 16 net worth may have come down, but it doesn't become exempt. Okay. So, in any of these 3 years, if it meets the criteria, it has to follow based on the phase dates. So, let us understand this better with some examples. First, let us see listed companies. So, 16/2/2015 Ind AS was notified. The first point A says 31/3/14. This point is talking of 31/3/14 and point B is talking of the later date. So, if net worth for listed companies was greater than or equal to 500 crores on 31/3/14, 15 or 16. So, what is the criteria for listed companies? If it is 500 crores or more, then for accounting periods commencing on or after 1/4/16, it has to follow Ind AS. If it is less than 500 crores, then it has to follow for accounting periods commencing on or after 1/4/17 only. So, when should we check this 500 crores? That is the question. So, in any of the 3 years, 31/3/14, 15 or 16, it was 500 crores. Then it has to follow Ind AS for the accounting period commencing on or after 1/4/16. If it was less than 500 crores in 31/3/14 and 15 and 16, all 3 years it is less than 500. Only then it can take advantage of the later implementation for accounting period commencing on or after 1/4/17. Now, let us look at unlisted companies. Here there is an extra layer. So, there is another threshold of 250 crores. So, for unlisted companies, if their net worth was greater than 500 crores, the situation is same as listed companies. So, greater than 500 crores in any of the 3 years, 31/3/14 or 15 or 16. Then it has to follow Ind AS for accounting period commencing on or after 1/4/16. The next here is slightly different. It should be less than 500 in all 3 years and greater than or equal to 250 crores in any of the years. Then it can take advantage of the later implementation 1/4/17. But what if it is less than 250 crores in all 3 years, 31/3/14, 15 and 16? Then Ind AS is not applicable till the net worth reaches 250 crores, and once it reaches 250 crores, from that next year it will start following Ind AS. So, I hope this exception is clear now. So, the general rule is if the criteria is met in 1 year, from the next year it will start following Ind AS. Exception was when the notification was issued. That time they said check the net worth on 31/3/14. If it met the criteria on 31/3/14, follow Ind AS either for accounting period commencing on or after 1/4/16 or 1/4/17. 31/3/14 it did not meet the criteria. 31/3/15 it met the criteria. Then also check the date either 1/4/16, 17. So, earlier it met the criteria, we lock it. So, 31/3/14 if it crossed 500 crores, then from 1/4/16 itself you have to follow Ind AS. Next year net worth may have dropped, okay. That does not mean you can take advantage of any exemptions. So, once you follow Ind AS, you have to follow once the criteria is met on in the earlier of the dates. Based on that only you have to follow the phase criteria, okay. So, if you met 500 crores in any of the 3 years, 1/4/16. For listed companies, less than 500 in all 3 years, 1/4/17. For unlisted companies, less than 500 in all 3 years and greater than or equal to 250 crores in any of the years, then 1/4/17. Less than 250 in all years, then no need to follow Ind AS, okay. So, let us go to some more points. The first set of financial statements when you prepare as per Ind AS, you should see the Ind AS that is applicable for the current year, effective for the current year. So, this is a logical provision. So, let us say 31/3/25 you are meeting net worth criteria. For 31,326 you are going to follow Ind AS. So see what all Ind AS are applicable for the year 31,326, right. Next is a very important point, and we sort of touched upon this point while seeing the first time implementation, that applicability of Ind AS is irrevocable. That means once you are covered under Ind AS, till that company is wound up, you will have to follow Ind AS only. So this principle only was there in the earlier of the 3 dates. 31,315, 31,314, you are meeting the net worth criteria of 500 crores or more. Then it is locked. 1416 itself you had to follow Ind AS. So 31,314, 15 and 16, all 3 years less than 500. Any of the years you meet 250 crores for unlisted company, then it becomes locked. 1417 you have to follow, or listed, you are listed, okay, in any of the 3 years, 1417, right. So this is similar to, if you have to understand it, an analogy, it is like the Voyager 1 satellite. So the satellite was launched in 1977. It is never going to return to Earth. It keeps going, okay, and it keeps sending back pictures of space. So Ind AS implementation is something like that. Once you are covered under Ind AS, till the company is wound up, you have to continue following Ind AS. So if a company is covered by the company's Indian accounting standard rules, then it should follow only Ind AS. If it is not covered by the rules, that is, it does not choose to voluntarily follow Ind AS, nor is it covered by the mandatory phases, then it should follow only the 27 notified AS. There is an exception. For the purpose of consolidation, another set of financial statements may be required to be prepared. So if a company is covered by Ind AS and is following Ind AS, it may be required to prepare for consolidation financial statements as per the 27 notified AS. Similarly, if a company is not covered by Ind AS, it is following notified AS, for consolidation it may be required to prepare Ind AS financial statements. All this we will see in the next few slides. So coming to the parent subsidiary relationship, for the parent company, once Ind AS is applicable, it should follow Ind AS for both its separate financial statements as well as consolidated financial statements. Separate financial statements means it's standalone. So if there is a company H Limited, it is covered by Ind AS, it is a parent company. For its own financial statements, that is only H Limited balance sheet, H Limited P&L, it will follow Ind AS. For the consolidated, that is including all its subsidiaries, also it should follow Ind AS. So fellow subsidiaries, associates and joint ventures are not automatically required to follow Ind AS. Only if they are covered by the criteria, they will have to prepare Ind AS compliant financial statements. Let us discuss an example. So suppose there is a parent company H Limited, it is not listed, okay, it has a net worth of say 200 crores. It has two subsidiaries S1 and S2. S1 has net worth of 300 crores, S1 also not listed. It has another subsidiary S2 which also has a net worth of 100 crores. So all these are unlisted companies. So which companies should follow Ind AS? So S1 is covered by Ind AS. Why? Because its net worth is more than 250 crores. What about H Limited? So H Limited is covered by Ind AS by virtue of being the parent company of S1. So if S1 net worth was not 300 crores, if it was say 50 crores. Then H also will not be covered, neither will S2 be covered. But now S1 is covered by Ind AS. H is covered because S1 is covered. So can we say S2 is covered because H is covered? So the answer is no. Okay, it is a fellow subsidiary. It is not a subsidiary of a company which is listed or which has a net worth of 250 crores or more. So in other words, being covered under Ind AS because of another company is not an infinite chain. Okay, only one level you see. So S1 is covered by Ind AS, H covered because of S1, but S2 cannot be covered because of H. But suppose H had 250 crores net worth or H limited was listed, then yes, S2 will be covered. So in other words, you can think of it like this: there is a direct coverage and an indirect coverage. Direct coverage if you fulfill the criteria, listed or net worth 250 crores or more. Indirect coverage, you are getting covered because of another company by virtue of the holding subsidiary or other relationship. Indirect coverage is only for one step. Okay, it's not an infinite chain. So here there is only one step. S1 covered, H1 covered because of S1, indirectly covered, one step. S2 covered because of H means it will become the second step of indirect coverage. So that doesn't work that way. So you can remember it like this. So direct coverage is there, indirect coverage for one step. Fine. So S2, and there is also a clarification issued that fellow subsidiaries are not covered by Ind AS by virtue of there being a fellow subsidiary. Okay. So just because S1 is covered and they have a common parent, S2 will not get automatically covered. Fine. So S2 is not covered by Ind AS. So that is the point we are discussing. So if not covered by the criteria, then they are not covered by Ind AS. Okay. But now there is another point. For the purpose of consolidation, they will have to prepare Ind AS compliant financial statements, because otherwise how will H limited consolidate its accounts? S1 is covered by Ind AS, H is covered because of S1, S2 is not covered. S2 will follow 27 notified AS. But how can H limited consolidate? How can it prepare one set of combined financial statements including S1 and S2 if S1 is as per Ind AS, S2 is as per AS? So S2 will have to end up preparing two sets of financial statements. So in such cases, what subsidiaries will choose to do is, oh, why this headache? I might as well follow Ind AS. Then I will need only one set of financial statements. So they always have that choice. Voluntary adoption is possible. Okay. So several points we have discussed here. By virtue of being a fellow subsidiary, you don't automatically get covered under Ind AS. Okay. You will follow 27 notified AS for your own financial statements. So S2 is going to prepare its own financial statements, give it to its shareholders, right? But for consolidation, who is preparing consolidated financial statements? H limited. At the time of consolidation, S2 limited tells H limited, see, I have prepared my financial statements as per 27 notified AS, but for consolidation I am giving you this set of financial statements as per Ind AS. Okay. So that is this point. If not covered by the criteria, the fellow subsidiary or associate or joint venture will not follow Ind AS for their separate financial statement, but still they have to prepare Ind AS compliant financial statement for the purpose of consolidation by the parent. Now I hope the previous chart also is clear. For the purpose of consolidation, okay, a second set of financial statements may be required. Fine. So we have seen the case which we are seeing now, the S2 subsidiary S2 is not covered by Ind AS, it is following 27 notified AS, but for the purpose of consolidation it is going to prepare Ind AS financial statements. So the next two cases that we are going to see relate to cross-border relationships. For example, the parent is an Indian company, the subsidiary is a foreign company. So subsidiary will prepare financial statements as per the foreign country's accounting standards, say UK accounting standards, and the parent Indian company will prepare financial statements as per Ind AS. So how does it consolidate the subsidiary's financial statements which is as per UK GAAP? It cannot. So the overseas subsidiary has to prepare another financial statements as per Ind AS, only then it can be consolidated here. Same way, when the parent is a foreign country, subsidiary is here, subsidiary will prepare as per Ind AS. For the purpose of consolidation, it has to prepare another set of financial statements as per the foreign country's accounting standards, only then it can be consolidated there. Okay, this is a simple logic. So first case is overseas subsidiary, associate, joint venture or other similar entities of an Indian company. So the parent is Indian company. So the overseas subsidiary will prepare its separate financial statements as per its jurisdiction. So let's say a UK subsidiary will prepare as per UK GAAP. The Indian parent has to consolidate as per Ind AS. Therefore, the overseas subsidiary should prepare another set of financial statements as per Ind AS so that it can be used for consolidation. Reverse is the next case. Parent is foreign and subsidiary, associate, joint venture is Indian. So this Indian subsidiary, what will the Indian subsidiary do? It will prepare its separate financial statements as per Ind AS. But for the purpose of consolidation of the foreign company, it has to prepare another set of financial statements as per the foreign accounting standards for the purpose of consolidation. So the next set of cases relate specifically to NBFCs. So there may be a parent subsidiary relationship between an NBFC, that is non-banking finance company, and a company which is not an NBFC, regular company. This NBFC is not covered by Ind AS, the other company being an NBFC is covered by Ind AS. So we are only looking at this one case. Under this there are two sub cases. We are not going to study a case where NBFC is covered by Ind AS and the other company is not covered by Ind AS and there is a parent subsidiary relationship. Why don't we need to study that case? Because all NBFCs are companies, but all companies are not NBFCs. So if NBFC itself is covered by Ind AS and another company which is a parent or subsidiary of this NBFC is not covered by Ind AS, by virtue of the parent subsidiary relationship, automatically it gets covered. So when NBFC is covered, the other company will automatically get covered. But when the other company being a non-NBFC is covered, does not necessarily mean NBFC will be covered. Why? Because NBFCs can be covered by the parent subsidiary relationship only if the other company is also an NBFC. In other words, for NBFCs to be covered indirectly by virtue of the relationship holding subsidiary, joint venture or associate, they should have that relationship with that other company which is also NBFC and covered by Ind AS. Okay. So for NBFCs it is more specific. By virtue of the parent subsidiary relationship, for an NBFC to be covered, that other company also should be NBFC. But that condition is not there for companies because all NBFCs are companies. So any company, if it is covered by Ind AS, that company may be NBFC. Then the parent or subsidiary of that company automatically gets covered, right? So I hope this point is clear. So coming back here, so the NBFC may be the parent or the subsidiary. Let us see both these cases. Suppose NBFC is the parent, right? It is following AS. Non-NBFC is covered by Ind AS. Let's say the other company has net worth of 300 crores. So it is covered by Ind AS. So NBFC is the parent. NBFC is going to prepare the consolidated financial statements. And it is going to prepare consolidated financial statements as per AS. So what should this non-NBFC do? Even though it is covered by Ind AS, because its parent is going to consolidate as per AS, this non-NBFC company should also prepare accounting standards, compliant financial statements for the purpose of consolidation, right? So if NBFC is the parent, for consolidation of the parent NBFC, the subsidiary company which is covered by Ind AS should also furnish financial statements as per the 27 notified AS. Okay. Let's go to the next case where NBFC is the subsidiary. So if NBFC is the subsidiary, then this NBFC is going to prepare financial statements as per accounting standards, right? But the non-NBFC is covered by Ind AS, has to consolidate as per Ind AS. So what should the NBFC do? For the purpose of consolidation, it should prepare an additional set of financial statements as per Ind AS, right? So if NBFC is the subsidiary, NBFC not covered by Ind AS, remember that is what we are seeing. NBFC is not covered by Ind AS. NBFC is the subsidiary. But for consolidation of the parent which is covered by Ind AS, what should the subsidiary NBFC do? It should additionally prepare financial statements as per Ind AS. So this can be summarized in the form of this slide. You can take a moment here and go through this slide. Please note that when we say consolidated financial statements, in the case of the subsidiary, it refers to the additional statement that it will prepare. Parent only is going to prepare the CFS. Subsidiary will have to prepare another set of financial statements for the purpose of consolidation. So that's what the entry here in this column means. So if NBFC is a parent and NBFC is a subsidiary, in these two cases, how will the financial statements be prepared? You can go through the slide. The next point that we are going to see is relating to joint venture versus joint operation. So we have seen that if a company is a holding subsidiary, associate or joint venture of another company which is covered by Ind AS, then by virtue of this relationship, the first company gets indirectly covered, right? So it's holding subsidiary, associate or joint venture. Now what is this joint venture? As per explanation B to section 2(6) of the Companies Act, the expression joint venture means a joint arrangement whereby the parties that have joint control of the arrangement also have rights to the net assets of the arrangement. Now, there is also separate Ind AS, Ind AS 111. So there also this similar terminology is used. So what is this control over rights to net assets and control of the arrangement? You take two companies A and B, they are just working together, they are making a product and they get a share of the revenue. So that is a joint operation. But if A and B, they form a third company C, they invest in this third company, they have an equal right to the net assets of C, then that would be a joint venture. Okay. So if A is covered by Ind AS, then C also will get covered by Ind AS because C is a joint venture of A. But if A and B are only in a joint operation, just because A is covered by Ind AS, B will not get automatically covered by Ind AS. So it has to be a joint venture. Joint operations without rights to net assets are not covered. That means a company cannot be covered by Ind AS by being a joint operation. It has to be a joint venture. So the next point is whether Section 8 companies are exempt from Ind AS. As per ICAI's clarification, Section 8 companies, say a Section 8 company is a subsidiary company of another company which is covered by Ind AS. Will this Section 8 company also get covered by Ind AS? ICAI says yes. Okay. So Section 8 companies are not exempt, Ind AS is applicable. So this is a list of the various Ind AS notifications issued till date. The first notification was in 2015, and then subsequently there have been amendment rules and second amendment rules. So this is for your reference. You can go through this list. So this is a list of Ind AS. So totally there are 39 Ind AS. So you can go through this list. So Ind AS 104 was now replaced by Ind AS 117. So after Ind AS 117, you see Ind AS 1, 2 and so on. So some Ind AS are numbered with a 3-digit number 101, 102. Some have either a single digit or 2 digits. So there is a reason why they have been numbered that way. So earlier we discussed that previously International Accounting Standards or IAS were issued. After IASC became IASB, whatever reporting standards were issued were called IFRS, right? So the Ind AS equivalent to IFRS will be a 3-digit number and corresponding to IAS will be either single digit or 2 digits. So broadly that is the numbering system. So the Ind AS corresponding to an IAS will have the same number as IAS. So if there is IAS 1, corresponding will be Ind AS 1. If there is IAS 12, it will be Ind AS 12. So it will either be a single digit or 2 digits. Okay. The Ind AS corresponding to an IFRS, that will be the IFRS number plus 100. So there is IFRS 1, there is IAS 1 and also IFRS 1. So Ind AS equivalent to IAS 1 is Ind AS 1, right? But the Ind AS equivalent to IFRS 1 is Ind AS 101. So Ind AS corresponding to IAS will be the same number, that corresponds to IFRS will be the IFRS number plus 100. That is why you have a 3-digit number. So another example for the numbering, previously there was IAS 17 leases and the corresponding Ind AS was Ind AS 17. This IAS 17 was replaced by IFRS 16. So now the corresponding Ind AS is Ind AS 116. So previously it was Ind AS 17 that was withdrawn. Now we have Ind AS 116. Next, let us look at the differences between Ind AS and IFRS. They are grouped into few categories. First category is called a carve out. So from the name we can understand something is removed. So how did we prepare this Ind AS? You had IFRS and we had our notified 27 AS. We tried to converge them. So certain things that are there in IFRS, they may not be applicable in the Indian context because of difference in economic environment and impracticality of implementing some provisions. So there will be a difference in the provision between Ind AS and IFRS, that is called carve out. So you are removing something. Okay. So pictorially we can remember like this. So let's say there is IFRS and Ind AS. IFRS has some provisions, a particular IFRS. Let's say that fourth provision says that certain transactions should be transferred to P&L. Now, if that provision were removed, you retain the same 3 points. Now, obviously, when you remove a provision, you have to have a corresponding different treatment in Ind AS. Okay. So you have to give an option. So instead of P&L that was there in IFRS, we make it as capital reserve in Ind AS, let's say. This would be example of a carve out. So you are removing a provision and you are replacing it. That is called carve out. Basically a difference in the provision between Ind AS and IFRS. This is just to help you remember. The next type of difference is called carve in. So let's say you have some provisions in IFRS. You are retaining the same provisions in Ind AS and you are giving some extra guidance. Okay, that would be called a carve in, or an extra option. That will be called a carve in. So carve in is something extra. Carve out is removing and replacing. Carve in is something extra. Okay, so these are the two main differences, okay, between Ind AS and IFRS. There are also some other differences. So there are differences in the terminology. In Ind AS, so what you see in blue in this chart is Ind AS, and what you see in green relates to IFRS. Okay. So in Ind AS we call it balance sheet. In IFRS it is called statement of changes in financial position. In Ind AS it is called statement of profit and loss, and IFRS it is called statement of comprehensive income. Now there are some options in IFRS which have been removed in Ind AS, but they do not result in carve outs. That is, substantially the provision is the same. We are limiting the choices. Okay, such differences are also possible. So for example, in IFRS, when we subsequently measure investment property, a choice is given, but in Ind AS 40, we are allowed to follow only cost model, whereas in IAS we are allowed to follow either cost or fair value model. So this option has been removed. So this is not considered as a carve out because substantially there is no difference in the provision. We are not saying instead of taking to P&L you take to capital reserve. We are not doing that. Basically we are limiting the choices. So that is not called a carve out. Okay. So then next type of difference is carve out. Differences in accounting treatment due to differences in the economic environment. An example is treatment of bargain purchase gain. In Ind AS 103, it is supposed to be credited to capital reserve. This is what we saw on the slide earlier. But in IFRS 3, it should go to P&L. So this bargain purchase gain is like, so let's say you are taking over a business, net assets is 100 crore and you are paying 120 crore. Why would you pay higher? You would pay higher for goodwill. But that 100 crore, if you pay only say 70 crore, why would you pay lower? So when you pay lower, it's like you have made a gain, you have bargained, you brought down the price. Okay, you are getting net assets worth 100, but you have paid only 70. Okay, so that is called bargain purchase gain. In Ind AS, it has to go to capital reserve, but in IFRS, it is credited to P&L. Okay. And the last type of difference is carve in, where additional guidance is given in Ind AS. So an example is common control business combinations, that is takeovers which are ultimately under the same control of the parent before and after the transaction. So guidance is given in Ind AS, but no such guidance is given in IFRS. So substantially you have carve outs which are differences in the provision. Then there are other differences in terminology, removal of options or additional guidance. There is no special term for removal of options, but when additional guidance is given, it is called a carve in. So carve out is the main substantial difference between Ind AS and IFRS. So next let us come to Schedule 3 of the Companies Act, the various divisions. So you have Division 1, which is for companies following AS, the 27 notified AS. Part 1 is balance sheet, equity and liabilities first, then assets. The balance sheet is based on non-current and current classification. Part 2 is statement of profit and loss. You have either profit or loss, and then you have notes. Division 2 is for companies following Ind AS. Part 1 is balance sheet. Additionally, we also have something called statement of changes in equity. Basically, what we give as notes in Division 1 showing the changes in equity comes here as a separate statement. That's all, not much of a difference. In Ind AS, first is assets, then equity and liabilities. Balance sheet classification is the same. Part 2 is statement of profit and loss. We get either profit or loss, and there is another part to this P&L called other comprehensive income or OCI, as we generally refer to it. And then we have notes. So certain items which are not supposed to be distributed but still reflect the performance, like for example that bargain purchase gain, that may have to be credited to other comprehensive income. All that we will see when we come to each standard. Then we have Division 3, which is for NBFCs following Ind AS. For them, Part 1 is balance sheet and statement of changes in equity with assets, then second liabilities and equity. The balance sheet is not based on non-current and current, but it's based on liquidity. Then Part 2 statement of P&L, profit or loss and OCI, and then notes. So the next point that we are going to discuss is, what if there is a difference between Ind AS and the law? Okay. So in the original notification, that is the 2015 notification, in the annexure under general instructions, it is clearly mentioned that if due to subsequent amendments in the law, Ind AS and the law there is a difference, then provisions of law should prevail. Okay. So Ind AS versus law, the law will prevail. Now another question may arise, what about a conflict between Ind AS and Schedule 3? For this you have to refer interpretation of statutes, which says that the specific provision will prevail over the general provision. Now is Ind AS part of the Companies Act? Of course. Why? because it is notified under section 133 of the Companies Act through the company's Indian Accounting Standard Rules 2015. So, Ind AS is very much part of the Companies Act. What about Schedule 3? Is it also a part of the Companies Act? Yes. So, that is included as part of the Act. So, therefore, which is the specific provision here? Specific provision is the Ind AS. So, what will prevail in case of conflict? Because Schedule 3 is like a schedule. Ind AS, there may be a specific case discussed. In this particular case, this is how it has to be presented. And that point, if there is a mismatch or if it is not dealt with specifically in Schedule 3, then obviously Ind AS will prevail. So, in case of a conflict, what will prevail? Ind AS will prevail over the Schedule 3 because it is a specific provision.